Alrighty. Hi everybody, this is Dan Sheridan. Welcome to the video for today, Wednesday, April 29th. Wonderful, beautiful, humid day here in Greenville, South Carolina. And as we look at the SPX chart here, it's Corona who? We're at 29.42 up over 2% in the SPX today, up 80 points. And, you know, we've gone up a couple hundred points in a week here. And the VIX has got decimated. In the last, as of today, Wednesday, April 29th, in the last 6 trading days, including today, 6 days, VIX has gone down 14 points. Ouch! Right now we're at 31.45. Definitely the lowest volatility that VIX has been in months, but historically it's still high. And as we're getting more range bound, things are calming down. And again, the market is looking very forward looking. And not that I think there will be some bumps, but this is the reality. I do think we're in a, again, I don't think we're going right back to 3,300 immediately, but we could. But so I'm looking, what's the reality of today? The reality is, as of today, what's the expected range over the next week? You say, what? You're getting a little goofy on me, Dan. What's this expected range nonsense? Well, it's just a standard deviation move. So if we look at 7 days from now, which would be May 6th, a week from today, the expected range is about 93 points. What does that mean in English, Spanish, and a little Norwegian? So it means that over the next week, right? If we're at, let me round this. We're at 29.43. I'm going to put 29.40 in SPX now because I could do math better on that. And the expected move is 93 points. Let me make it 90 points. I could do math better on 90 than 93. So it's looking, the projected range over the next week is 28.50 from today. The expected range is 28.50 to 30.30. Again, what does that mean? It means there's a 68% probability. That's one standard deviation. It's the expected rate. That's where we're going to be. Does that give you an idea? Yeah. It gives you an idea of where the price will be in the next week. Helps your position trades that way. I mean, VIX is 31.39. It sure looks like it wants to go under 30 until it does. You know, I've thought for the last month, we've been, but you know, I've been looking at a VIX range of 30 to 45. It looks like we're going to go below 30 if we keep going up, but until we go under 30, I'll still say 30 to 45, right? We have not beat it, and I've actually bet a couple students in Sheridan Mentoring today some Portillo's Italian beef and hot dogs. Both veteran students, very good traders, both smarter than I am. That's not saying a whole lot, but they are smarter than I. They think the VIX is going to go under 27 in the next 6 days. This is where we're at now. And I say we're not. Winner gets Portillo's beefs and hot dogs. I will keep you posted. Okay, let's look at a trade today. Again, volatilities are high enough. If you're still bullish on stuff, let's give you an example. One stock that is just, as Dionne Warwick would sing, up, up, and away. Remember that one? Let's give you an example in Apple. So if you're bullish on Apple, but you want some protection to the downside, what's a covered right alternative that I would look at right now? And let's look at buying the June 19, buying a diagonal, buying the June 19, and selling a closer in expiration. So we're going to buy the June 19. Let's buy a stock surrogate, maybe an 80 delta. June 19 is 51 days out. So maybe something like a 260 call. So I'm going to buy an in the money call. It's about 27 points in the money. Again, long diagonal is a covered right alternative, but much, much cheaper because you're not buying stock. If you do a covered right in Apple one time, it's going to cost you like $28,000 because that's what you have to buy 100 shares of stock at 287. Whereas a long diagonal is going to cost a fraction of that, like 2,500. So I buy the 260 call, and then I go against that 51 days out, and I'm going to sell maybe the May 22s 23 days out, maybe a little bit below the current price, 285. That will give me a little bit of downside protection if we back off. The nice thing is the volatilities are still historically high. So what I like about it is you're going to be short Vega. If the volatilities continue down, you'll be fine. Let me just see, this doesn't look right. Let me just make sure. I'm buying the June 19s. Haha. I'm selling the May 22, 23 days out. $285 call. So it looks as my Italian mother-in-law would say, it looks a little bit like this. So here we go here. Here we are, 287.55 in Mr. Apple. Again, hey Dan, it looks like a covered right. Here's the expiration graph. Do great on the way up, and you get some protection. Here's your expiration break-even point, where the expiration line crosses 0 at expiration. So you get maybe down to 275. You get about $12, right? So about 5% downside protection. Nice positive theta. I'm sorry, your Vega's pretty neutral. But again, it's costing you $2,100 for a long diagonal. A covered right's going to cost you $25,000. You tell me, right? And it's nice. And this is your graph at expiration. This is your graph now. All right, that's my 2 cents. Check out Sheridan Mentoring. If you like our teaching, we have a great new product. Our basic program, which is about $100 a month. And it gives you 2-3 hours of live teaching a day where you're seeing Mark Fenton and myself go through trades, putting trades on, managing a portfolio. Great practical experience. Check it out. Thank you.